Now, net tax payable by B to the central government in the form of IGST is rupees 900 after taking the benefit of input tax credit. Here, the IGST charged by X Limited of Telangana for supply of the goods will be remitted by B of Karnataka to the appropriate account of the central government. Now here B is liable to pay IGST of rupees 900 in the account of the central government, net IGST of rupees 900 on the account of the central government. Now here, at the time of the sale of goods by A to B, Telangana government, that means the Telangana state where from the sale was made by A to B, here the Telangana government collect SGST at rupees 4,500. But since the goods are not consumed in the state of Telangana, here the amount of SGST that is to be collected by the Telangana state is to be transferred to the account of the central government. So here rupees 4,500 which is collected by Telangana state is to be credited in the account of the central government, because here IGST is collected by the central government, CGST is collected by the central government, so that credit can be adjusted among themselves. But here when the supplier adjusts the credit of SGST against IGST, here the respective state government is responsible for transferring such SGST in the account of the central government, because that SGST was collected by the Telangana state, but the product is not consumed in the state of Telangana. So here the Telangana government is not eligible for collection of, for revenue, for getting revenue on account of this transaction. Here the revenue that was generated in the hands of Telangana government in form of SGST should be transferred in the account of the central government. Now the third sale was contemplated between X Limited and Y. X Limited of Telangana here the SGST that was collected from the first sale, that SGST was collected by the Karnataka government. Since the product is not consumed in the state of Karnataka, here the Karnataka government is not liable for generating any revenue from the sale of that product. Here the Karnataka government is responsible for transferring such amount of SGST, such amount of the revenue that was collected by it on the account of the central government, because that product is not consumed in the state of Karnataka. We know that GST is a destination based tax. Since the product is not consumed in the state of Karnataka, it is transferred in the state of Telangana here, and at the time of supply of the goods from Telangana, from Karnataka to Telangana, here the seller taking the benefit of input tax credit in the form of SGST, here Karnataka government is responsible for transfer of such credit in the account of central government. I repeat again, here the Karnataka state is not eligible for collecting any revenue on account of such transaction, because that product is finally not consumed in the state of Karnataka. Since Karnataka government already collected revenue in the form of SGST amounting to rupees 4,500, that revenue is to be transferred by the Karnataka government on the account of central government, because here at the time of second sale, that means at the time of interstate sale from Karnataka to Telangana, here the supplier, that means here the seller, enjoy the input tax credit in the form of SGST. That means here the revenue of central government get decreases, here that revenue is being decreases by way of the SGST, and that SGST was collected by the Karnataka government on account of the first sale, and that revenue is to be transferred by the Karnataka government on the account of the central government. Here it is being written that IGST charged by X Limited of Telangana for the supply of the goods will be remitted by B Limited of Karnataka to the appropriate account of the central government. Karnataka government will transfer SGST credit of rupees 4,500 utilized in the payment of IGST to the central government. Now, here the third sale is being made by X Limited of Telangana to Mr. Y of Telangana. So, Y is the final consumer of the product. Now, the third sale is being made from Telangana to Telangana. So, it is a intrastate sale. Here the sale are also made by adding 10% value. So, here the value charged by the supply of the goods and services will be 55,000 plus 10%, and it comes to 60,500. Since it is a intrastate sale, output tax will be in the form of CGST and SGST. Here CGST will be at the rate of 9%, comes to 5,445. SGST at the rate of 9% comes to 5,445, and total price that is charged by Mr. X, total price charged by X Limited for making sale to Y comes to 71,390, which comprises of CGST of rupees 5,445 and SGST of 5,445. This is the output tax from the viewpoint of the X Limited. Now, X Limited has the output tax in the form of CGST of rupees 5,445 and in the form of SGST of rupees 5,445. Now, X Limited purchased such goods from supplier of Karnataka by paying IGST of rupees 9,000. Now, here X Limited is liable to take input tax credit of IGST first against SGST and then any balance remaining against SGST. Here first credit, here output tax of X Limited is in the form of CGST and SGST, because here the sale are made from Telangana to Telangana. That means sale are made on intrastate basis. Here the output tax will be in the form of CGST and SGST. So X Limited are liable to pay output tax in the form of CGST amounting to rupees 5,445 and in the form of SGST amounting to rupees 5,445. But against these output tax, X Limited are able to take input tax credit which it was paid at the time of purchase of goods from Karnataka. Now, since it was a interstate sale, X Limited paid IGST at the time of purchase of such goods. Now, that IGST can be adjusted against CGST and SGST, but whenever the input tax credit of IGST is to be taken against against CGST and SGST, first it is to be adjusted against CGST, because both IGST and CGST, both these tax are collected by the central government. So whenever input tax credit of IGST is to be taken, first it is to be taken against CGST, and then if any balance is remaining thereafter, it is to be credited, against SGST. Now here, first CGST paid by the output tax of CGST of X Limited is 5,445. Against this, it will take input tax credit of IGST. Here total IGST paid by the X Limited at the time of purchase is 9,900. So entire amount of CGST is to be writing off by taking credit of IGST first, and then the SGST amount was rupees 5,445, and from this SGST he will take the balance amount of IGST that was paid by X Limited at the time of purchase, and total amount of IGST paid at the time of purchase was 9,900, and already IGST of rupees 5,445 is adjusted against CGST. So balance of IGST is to be adjusted against SGST, and here the remaining amount of SGST is to be paid by X Limited on the account of Telangana state, and it comes to rupees 990. This is the net GST liability that is to be paid by X Limited in form of SGST in account of the Telangana government. Now here central government is responsible for making transfer of rupees 4,455 in account of the Telangana state, because at the time of paying the output tax by X Limited, it will take the benefit of IGST. So here the revenue of the state government get decreases through IGST, through the credit of IGST. So here, since the revenue of the respective state, that means Telangana, get decreases because of IGST, here the central government is responsible for transferring that IGST in the account of the respective state government, that means on the account of the Telangana state. Now here central government will transfer IGST credit of rupees 4,455 utilized in payment of SGST to the Telangana state.